EPK Capital presents Daily Brief, 20th August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. Opening bell. A day of divergence and anticipation. The global financial markets presented a complex and divided picture on Tuesday, August 19th, 2025. The day's narrative was not driven by a single, overarching theme, but by a sharp divergence in regional sentiment and performance. In the United States, the focus was squarely on an internal reckoning, as the high-flying artificial intelligence and technology sectors faced a significant pullback after months of spectacular gains. In contrast, European markets looked outward, reacting with cautious optimism to major geopolitical developments that signaled a potential de-escalation of the war in Ukraine. Hovering over this entire landscape was a palpable sense of anticipation. Investors across all asset classes, from equities to commodities to crypto, seemed to be holding their breath for the week's main event, the Federal Reserve's annual economic symposium in Jackson Hole, Wyoming. This created a pervasive wait-and-see atmosphere, where even positive economic data struggled to move the needle decisively, leaving markets in a state of suspended animation ahead of what could be a pivotal moment for monetary policy. Global market snapshot, the closing numbers. To fully grasp the day's divergent paths, a look at the closing figures from major global indices is essential. These numbers immediately reveal the day's core theme. The weakness in the U.S. was concentrated in its most dynamic sector, technology, which dragged down the broader S&P 500 and the tech-heavy NASDAQ. The Dow Jones Industrial Average, with its lower concentration of high-growth tech, remained remarkably resilient. At the same time, European markets staged a broad rally, and Asian markets were mixed, with India showing notable strength against its regional peers. This global divergence indicates that on this day, markets were decoupled from a single macro narrative. The primary news driving European sentiment was geopolitical. The Trump-Zelensky summit was perceived as a positive step toward de-escalation, reducing regional risk. Conversely, the main story in the U.S. was a domestic, sector-specific rotation out of stocks perceived as overvalued. This suggests investors are becoming more discerning, punishing specific areas of perceived excess while rewarding regions with an improved risk profile. U.S. markets. In depth, the AI rally hits a wall. The tech tumble. The dominant story on Wall Street was a significant sell-off in the technology sector, particularly among the AI darlings that have led the market's ascent for months. The NASDAQ composite bore the brunt of the selling, falling sharply by about 1.5%. This was not a reaction to a specific piece of negative news. Instead, it was fueled by a growing sentiment that the AI-fueled rally had become overextended. For weeks, criticism has been mounting that stock prices have shot too high, too fast, since the market bottom in April, leading to widespread concerns about stretched valuations. Tuesday's action suggests that sentiment finally translated into significant profit-taking. The heaviest weight on the market was NVIDIA, the chipmaker at the heart of the AI revolution, which saw its shares sink 3.5%. The pain was even more acute for Palantir Technologies, another AI favorite, which plummeted 9.4% to become the S&P 500's worst performer. This drop came as data showed a sharp buildup in short interest, where traders are betting the stock's price will fall. Other major technology names, including Meta Platforms, 2.1%, Amazon, 1.5%, Oracle, 4.9%, and Advanced Micro Devices, 4.9%, also posted notable declines. Dow's defensive stand. In a stark contrast that highlighted the day's rotational nature, the Dow Jones Industrial Average finished the session nearly flat, inching up by just over 10 points, or less than 0.1%. The Dow's stability was largely attributable to a single component: Home Depot. The home improvement retailer's stock gained 3.2%, providing the biggest lift to the index. This positive reaction came despite the company reporting quarterly results that missed both analyst expectations for profit and revenue, the first time this has happened since 2014. Investors looked past the miss, focusing instead on the fact that Home Depot stood by its full-year guidance for both revenue and profit. In a market nervous about the future, this signal of stability was rewarded, illustrating a clear shift in investor preference from pure growth narratives to companies with predictable earning streams. Noteworthy corporate movers. Beyond the broad sector trends, several individual companies made significant moves on specific news. M&A activity. Shares of human resources software provider Dayforce, Day, skyrocketed 26%, making it the top performer in the S&P 500. The surge followed reports that private equity firm Thoma Bravo is in discussions for a potential buyout. Regulatory tailwinds. Solar energy stocks rallied after the U.S. Treasury Department issued new guidance on clean energy tax credits. The new rules, while limiting some projects, were viewed by analysts as less restrictive than investors had feared. This provided a boost to the sector, with First Solar, FSLR, jumping 9.7%. Strategic investments. Intel, INTC, shares climbed over 5% following an announcement that Japanese conglomerate SoftBank would invest $2 billion in the U.S. chipmaker. This positive news overshadowed earlier concerns that the Trump administration might convert grants from the CHIPS Act into an equity stake in the company, a move that could dilute existing shareholders. The day's price action represents a textbook example of a market rotation. In an environment of heightened uncertainty ahead of the Federal Reserve's pivotal meeting, investors are actively de-risking their portfolios. This involves taking profits from the year's biggest winners: high-growth, high-valuation AI stocks like NVIDIA and Palantir, and reallocating that capital into more defensive, value-oriented companies with stable and predictable outlooks, such as Home Depot. This is not simply random profit-taking. It is a rational, fear-driven portfolio adjustment. The market is signaling that the growth at any price narrative that defined the AI rally is being seriously questioned. Investors are now demanding more than a compelling story. They want proven earnings stability, a trend that could mark the beginning of a broader shift in market leadership if the Federal Reserve signals a more hawkish stance on interest rates. The geopolitical factor. Washington summit shakes global markets. Diplomacy and de-escalation. While U.S. markets were consumed by internal sector rotation, the rest of the world was focused on a high-stakes meeting in Washington. The summit between U.S. President Donald Trump, Ukrainian President Volodymyr Zelensky, and several key European Union leaders became the single most important driver for international markets. While the meeting did not produce a concrete peace deal, the overall tone was one of cautious optimism. President Trump publicly signaled his support for European-led security guarantees for Ukraine and announced that he had begun arrangements for a trilateral meeting that would include Russian President Vladimir Putin. For markets that have been pricing in a prolonged conflict, this dialogue was interpreted as a meaningful step toward reducing geopolitical risk. European market reaction. This geopolitical development was the primary catalyst for European equities, which closed broadly higher across the continent. The CAC 40 in France rose 1.2%, the DAX in Germany added 0.5%, and the Pan-European STOXX 600 gained 0.56%. The most direct and telling market impact was seen in the European defense sector. The prospect of peace, however tentative, led to a sharp sell-off in companies that have benefited immensely from increased military spending since the start of the war. Shares of Germany's Rheinmetall, a major arms manufacturer, fell between 4.7% and 5.0%, while French defense electronics group Thales saw its stock drop 4.1%. This was a clear sell the news reaction, as the market immediately began to reprice the probability of future defense contracts. Commodities and currencies. The summit's ripple effects extended far beyond equities, influencing key commodity and currency markets. Oil prices. Decline. Crude oil prices fell on the prospect that a peace deal could eventually lead to an easing of sanctions on Russian energy exports, which would increase global supply. West Texas Intermediate, WTI futures, the U.S. benchmark, slipped to around $63 per barrel, while Brent crude, the international benchmark, dropped to near $66 per barrel. Gold and dollar. Gold, a traditional safe haven asset, saw its appeal diminish as geopolitical tensions appeared to ease. The precious metals price was down slightly, trading around $3,330 to $3,380 per ounce. The U.S. dollar index, which measures the greenback against a basket of other currencies, rose modestly to 98.15 as investors looked ahead to signals from the Federal Reserve. Treasury yields. The yield on the 10-year U.S. Treasury note, a key benchmark for borrowing costs, ticked down slightly from 4.34% to 4.30%. This reflected a modest flight to the safety of government bonds amid the U.S. stock market's tech-driven weakness, though the move was muted as the bond market also awaits clarity from the Fed. The market's reaction to the Washington summit provides a rare and clear-cut example of how a political event can have an immediate, inverse, and quantifiable impact on specific market sectors and asset classes. The first-order effect was clear. The perceived likelihood of continued conflict decreased, causing the market to reprice future demand for military hardware lower, leading to a sharp drop in defense stocks. Simultaneously, the market priced in a higher probability of future Russian oil supply returning to global markets, causing crude prices to fall. The second-order effect was a broad rally across European indices, as the reduction in war-related risk and the potential for lower energy prices, which would help ease inflation, was seen as a net positive for the European economy. This demonstrates the market's efficiency in pricing geopolitical risk and highlights a key vulnerability for the defense sector's recent rally, which remains highly sensitive to the peace narrative. Economic pulse. Housing strengthens, labor market diverges. On the economic front, new data released on Tuesday painted a picture of an American economy with underlying cross-currents, where strong headline numbers masked regional weaknesses and forward-looking concerns. U.S. housing sector data for July from the U.S. Census Bureau and the Department of Housing and Urban Development revealed a surprising rebound in home construction activity. The numbers. Overall housing starts rose 5.2% from the previous month to a seasonally adjusted annual rate of 1.43 million units, comfortably beating expectations. The increase was broad-based, driven by a 2.8% rise in single-family starts and a robust 9.9% jump in the more volatile multifamily sector, which includes apartments and condominiums. The contradiction. This strong headline number stood in stark contrast to the mood among home builders themselves. The National Association of Home Builders, NAHB, Housing Market Index for August fell to a reading of 32. This indicates deep pessimism and is a low level not seen for the month of August, since the housing market was recovering from the Great Recession. Builders cited significant challenges from persistently high mortgage rates, skilled labor shortages, and excessive regulatory costs. Reflecting these difficulties, a growing number of builders, 66% in August, reported using sales incentives like price cuts or mortgage rate buydowns to attract buyers and close deals. U.S. labor market. The Bureau of Labor Statistics, BLS, also released its State Employment and Unemployment Summary for July 2025, revealing significant divergence beneath a stable national surface. National picture. The national unemployment rate held steady at 4.2%, unchanged from the previous month, and the same as in July of the prior year. State-level divergence. The report highlighted vast differences at the state level. South Dakota boasted the lowest unemployment rate in the country at just 1.9%. The Washington, D.C. story. At the other end of the spectrum, the District of Columbia recorded the highest unemployment rate in the nation for the third consecutive month, with its jobless rate reaching 6.0%. This localized economic distress has been directly attributed to a specific policy: the mass layoffs of federal workers initiated by President Trump's newly created Department of Government Efficiency. The day's economic reports demonstrate that headline figures can mask underlying weaknesses. The rise in housing starts appears bullish, but the collapse in builder confidence is bearish. Both can be true because housing starts are a lagging indicator, often reflecting projects initiated months earlier, while the confidence index is a forward-looking measure of future activity. This suggests that while current construction is holding up, a slowdown is highly likely in the coming quarters. Similarly, the stable national unemployment rate suggests a healthy labor market, but the situation in Washington, D.C. shows a pocket of severe economic pain directly caused by government policy. These data points reveal that the U.S. economy is not monolithic. An investor looking only at national headlines would miss the forward-looking weakness in housing and the politically driven job losses in the nation's capital. The crypto corner, macro fears. Trigger a sell-off price action and liquidations. The digital asset market experienced a significant downturn on Tuesday, driven by the same macroeconomic anxieties that were unsettling traditional markets. In a 24-hour period, over $400 million in leveraged cryptocurrency positions were liquidated, a sign of a sharp and painful move for speculative traders. Key levels. Bitcoin, BTC, the market's bellwether, slipped below the key psychological and technical support level of $115,000. Ethereum, ETH, the second largest cryptocurrency, fell below $4,200. This sell-off wiped an estimated $75 billion from the total cryptocurrency market capitalization. Analysts are now closely watching the $115,000 to $115,500 range for Bitcoin, viewing it as a critical support zone that must hold to prevent a deeper correction. The macro connection. Notably, this sharp sell-off was not triggered by any negative news from within the crypto ecosystem itself. Instead, it was a direct reaction to the same macroeconomic headwinds affecting Wall Street, rising anxiety ahead of the Jackson Hole Symposium. The fear. Crypto investors are concerned that Federal Reserve Chair Jerome Powell may deliver a hawkish message, signaling that the central bank intends to keep interest rates higher for longer to combat inflation. Such a stance reduces overall market liquidity and dampens investor appetite for high-risk, high-growth assets, a category that prominently includes cryptocurrencies. The price action makes it clear that the digital asset market is now trading with a high correlation to risk assets on Wall Street. Key industry developments. Despite the negative price action, the day brought several significant developments for the crypto industry. Fed Governor's landmark speech. In what could be a pivotal moment for digital asset regulation in the U.S., Federal Reserve Governor Michelle Bowman delivered a landmark speech at the Wyoming Blockchain Symposium. She called for regulators to embrace innovation and move away from an overly cautious mindset. She specifically addressed the need for a clear regulatory framework for stablecoins and the tokenization of real-world assets. In a crucial policy shift, Bowman announced that the Fed would no longer consider reputational risk in its supervisory process, a key step in addressing the debanking phenomenon where banks have been hesitant to provide services to crypto firms. Regulatory and product news. On the regulatory front, the Securities and Exchange Commission, SEC, once again delayed its decisions on multiple pending applications for crypto exchange-traded funds, ETFs, pushing the timeline to at least October. In product news, trading platform Robinhood announced a partnership to launch sports betting prediction markets, further integrating crypto-adjacent products into its offering. In a move to expand interoperability, the popular crypto wallet MetaMask announced a native integration with the Tieron network, one of its most significant moves beyond the Ethereum ecosystem. The day's events highlight a fundamental paradox in the evolution of cryptocurrency. As the asset class becomes more integrated into the mainstream financial system, it gains legitimacy, but loses its coveted status as an uncorrelated hedge against traditional market movements. Bitcoin's price is now falling for the exact same reason that high-growth tech stocks are falling: fear of what the U.S. Federal Reserve will say. At the same time, a U.S. Federal Reserve governor is delivering a detailed and largely positive speech about creating a durable regulatory framework for digital assets within the traditional banking system. The very institutional adoption and regulatory clarity that the industry has long desired is what is causing it to behave more like a traditional asset class. This is a pivotal moment. The long-term bull case for crypto may rest on its integration into the global financial system, but in the short to medium term, this very integration makes it more vulnerable to the same macroeconomic cycles that govern stocks and bonds. The road ahead. All eyes on Jackson Hole. Tuesday's session wove together several disparate threads: a technology sector showing signs of valuation fatigue, a European market buoyed by fragile diplomatic hopes, mixed signals from the U.S. economy, and a crypto market now firmly tethered to macroeconomic fears. The single unifying theme across all these stories is uncertainty about the future path of monetary policy. The market is in a holding pattern, with investors across the globe largely refraining from making aggressive new bets until they receive clarity from the world's most powerful central banker. The Jackson Hole Economic Symposium, and specifically Federal Reserve Chair Jerome Powell's speech scheduled for Friday, is now the single most important catalyst on the horizon. His remarks on the state of inflation, the health of the labor market, and the central bank's outlook on potential interest rate cuts will set the tone for all asset classes, from stocks to bonds to crypto, for the remainder of the quarter. The cautious, divergent, and rotational trading seen today is a direct result of the entire financial world bracing for this pivotal event. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.